Nonprofit organizations can be rewarding to their employees in several ways. Not only do they feel good about what they're doing, but they can also have benefits like traditional 401k plans and 403b plans. So which types of plans might be right for your organization, and which ones can help you manage your costs as you run the plan? Hi, I'm Justin Pritchard, and we're going to cover several nonprofit retirement plan options, including 403b plans, 401k plans, and other types of plans that might help you manage expenses and help people save for retirement and potentially manage their taxes. In the past, 403b plans got all the attention for nonprofit organizations, and that was for good reason. But over the years, the rules have changed so that nonprofits can use other types of retirement plans as well, and it may even make more sense to do so. So we will get to some of the unique pros and cons of having a 403b plan, but we'll also talk about other options that might make sense for your organization. And as a quick overview, we can look at how 401k plans and 403b plans compare and contrast so you get an idea of why 403b isn't quite as popular as it used to be. Number one is that 401k plans and most 403b plans nowadays for private nonprofits, we're talking here for the most part, both of those plans need a written plan document, and they essentially look and feel like a 401k plan. So number two, there are more 401k providers out there than there are 403b providers. The result is that you have more competition, and typically that brings down the pricing on 401k plans compared to 403b plans, where you don't have quite as much choice. The last thing is that not every not-for-profit organization is able to have a 403b plan. So you've got 501c6 trade groups, for example, that can't have a 403b, so they might have a 401k anyway. The good news is that employees can save quite a bit of money in both 401k plans and 403b plans if they choose to do so. So both types of plans have the maximum $19,000 of salary deferral in 2019, and that should change in future years with inflation. Those over age 50 also have an additional catch-up contribution available to them of $6,000. Again, that could change over the years. And the total contributions that go into an employee's account can be as high as $56,000 for 2019. So that would include the employee's own contributions out of their pay, as well as any employer money that comes in on top of the employee's contributions. So those are some meaningful amounts. The one caveat is that 403b plans may have an additional catch-up contribution for certain employees, and we'll talk about that a bit later. Some other similarities include the ability to make either after-tax or pre-tax contributions to the plan. So if the plan allows it, if the employer sets this up, employees can make after-tax Roth contributions if they choose to do so, or they can make pre-tax, you might call them traditional contributions, or they can mix and match and make some combination of both. What's more, there may be loans and hardship distributions available from both types of plans. Again, these are options that the employer can add but doesn't have to offer. One potential drawback for nonprofit organizations who are often concerned about cost might be the administrative costs of running a 401k plan, as well as some of the employer contributions that might be required. So it can maybe cost a couple $1,000s to run a 401k plan. For a lot of organizations, that's not an option. The board of directors is concerned about directing those funds towards the mission, and they don't necessarily want to pay administrative expenses, maybe on top of even contributing to employee accounts. So that can be a challenge if a nonprofit wants to offer a 401k or a 403b plan in some cases. What you should know is a quick overview about 401k plans is that sometimes they have discrimination tests that mess up what you think your budget is going to be for the year, or what an employee thinks that their contribution is going to be for the year. So for example, if somebody's trying to contribute a lot of money, but others in the plan are not contributing quite as much, it can restrict an employee's ability to make the full contribution, that full $19,000, for example. Or if plan assets kind of stack up in too heavy a way, then that can require the organization to make a contribution of 3%, what might be called a top-heavy contribution to the plan. And if the organization doesn't expect that, that's obviously not a great thing. So 401k plans are pretty powerful, but you need to be aware of the pros and cons of using a 401k plan. The good news is that there are less expensive options out there, and they have pros and cons, of course. So one of them that you might want to look at is a SIMPLE plan. It's called a SIMPLE, which is an IRA type of plan, stands for Savings Incentive Match Plan for Employees. And what that does is helps people save, again, quite a bit of money each year if they choose to contribute out of their pay into the plan. They can save up to $13,000 per year in 2019. And those employees over age 50 can make an additional $3,000 catch-up contribution on top of the $13,000. So what do you need to know about SIMPLE plans? A couple of things. Number one is there is no option to make Roth contributions. So if somebody wanted to make those after-tax Roth contributions, they just can't do it in a SIMPLE plan. It's all going to go in pre-tax and then eventually have income taxes on it when it comes back out. Another thing to know about is that there are no loans in SIMPLE plans. So again, a 401k or 403b, if the employer offers it, can allow somebody to borrow up to $50,000 or 50% of their vested account balance, whichever is less, but a SIMPLE does not offer. And another thing to know about is that SIMPLEs have basically immediate vesting. So when the money goes in, it technically goes into an IRA account, an individual retirement account in the employee's name. At that point, they can take the money right back out immediately if they want to. That may or may not be a problem, but if you did want to encourage people to keep their money saved for the long term, or if you want to give an incentive for people to stay with the organization for several years, then that ability to take the money right back out is a little bit different than what you have in a 401k plan. And finally, you can only have a SIMPLE plan in a given year. You can't also have a 401k plan in that same year. So if you decide to switch to a 401k plan, let's say after having a SIMPLE plan, you need to plan ahead to make sure that they don't run over each other and cause any problems. So let's talk about costs. What does it cost to run a SIMPLE plan? It's essentially just the contributions that you make for employees. So that might be one of two choices that you have. You can either give 2% of the employee's compensation each year, that just goes to the employee whether they contribute or not. The other option is to give a 3% match on what the employee contributes. So if they contribute 0, then nothing goes in from the employer. But if the employee contributes 3%, they basically get a 100% match on that. If they do 10%, you're only going to match them up to 3% of their compensation. And in very limited cases, you can reduce that just a little bit in certain years, but don't count on that. Plan on doing either the 2% contribution or the 3% match. Other than that, there are no administrative costs really with a SIMPLE plan. It's really just the time it takes for you to enroll employees, maybe communicate to them about the plan, deal with it in payroll, making sure that it gets over to the vendors correctly. But there isn't like an actual hard dollar cost that you pay to run a SIMPLE plan in your organization. So that's appealing to a lot of nonprofits, especially small nonprofits with limited funding. A payroll deduction IRA is another option, and that's another step down in terms of how much you can contribute each year to the plan, as well as any costs to the employer. So a payroll deduction IRA is kind of what it sounds like. You just set up IRAs for people or have them do it, and then you contribute out of their pay into their own IRA. It's not really an employer-sponsored plan that requires an employer contribution, like a matching contribution or a profit-sharing contribution or anything like that. It's just a way to make it easier for employees to save money into the plan. Sometimes all it takes is making things easier and people take the right actions. If you can just give them a roadmap to save some money, they will end up saving some money. And that's what a payroll deduction IRA does very well. So the costs, again, are basically just the administrative tasks of dealing with the contributions, talking with employees about it if you talk with them. And definitely don't give investment advice if you're not licensed to do that, but you can let them know how the basics work, that you have a plan that takes money out of their pay and then goes over to a vendor, and over there the employee can choose certain investments if they want to do that. The good news for employees is that they can make either pre-tax, traditional, or Roth contributions. Now, whether or not they're eligible to do so is a question, and that's something that each employee needs to verify for themselves. So in a 401k, for example, it's a little bit different. Anybody who's eligible to contribute can make Roth contributions up to $19,000, and that's very simple and easy for people to understand. But in an IRA, they might not be allowed to make Roth contributions. They might not be able to make pre-tax contributions, or they might not be able to deduct those contributions on their tax return. They should typically be able to at least make a contribution, and whether or not it's Roth or deductible or not is going to be a question for their CPA. So it does put a little bit more work on employees. They need to be just a little bit more engaged, but at least you're getting the money out of their pay and into their retirement account before they have the chance to spend it, and that is a lot better than nothing. Another thing to know about those payroll deduction IRAs is that it's not automated, so you're not going to reduce the W-2 that says you put in this much to the plan and therefore your taxes are lower. Again, the employee needs to deal with that all on their own. Some good news, though, is that there is no discrimination testing. You're not going to have to look at how much each person contributed compared to some of the other employees, and did they contribute too much or not. That is the case with a 401k plan. You do need to typically look at who's contributing, how much are they putting in, and is there any disparity that the IRS doesn't like. That gets really complicated. We can talk about that another time, but that doesn't happen with the payroll deduction IRAs or the simples. And another thing to just be aware of with the payroll deduction IRAs is, again, it's an IRA, so the employee is effectively 100% immediately vested. And it is their own money, so why shouldn't they be? It just came right out of their pay and they put it in the account so they can take the money right back out whenever they want to. And before we get to the 403B specifics, just want to mention that there are some other options out there. They're not the ones that most small nonprofits are looking for. These might make more sense to organizations that have highly paid employees, really highly paid employees, or huge cash flows coming through so they can afford to make large contributions for employees. And those would include a defined benefit plan or a non-qualified deferred compensation plan, maybe a 457F. So those are options for a limited subset of not-for-profit groups. Okay, before you rule out a 403B plan, you might want to know at least what makes them unique, and should you maybe try one out instead of using a 401k plan. So what makes 403Bs unique? And one of them is that there's not as much discrimination testing, and that kind of depends on the organization and are you going to make any employer contribution or not. But you can really lighten the load on the discrimination testing if you have a 403B with no employer contribution. Now, what does that mean in plain English? Essentially, that means that if you have highly compensated employees who are trying to contribute a lot into the plan, and then you have rank and file employees who don't earn as much and they choose not to contribute to the plan, sometimes that can cause problems, which disqualifies the highly compensated employees from making as big of a contribution as they want to. So they can't save as much as they might want or need for retirement, and that frustrates them. They might get refunds from the plan. It's inconvenient dealing with their taxes. So if you can eliminate those discrimination tests, that may be beneficial for your organization. Something else that's unique to 403B plans is the additional catch-up contribution. So this may be hard to qualify for, but in the right cases, it can be helpful. So employees who have been employees of the organization for over 15 years may be able to contribute an additional $3,000 per year. Now this gets pretty tricky. I'm going to read off a list here because your organization has to be a public school system, hospital, home health service agency, health and welfare service agency, a church, or a convention or association of churches or associated organizations. So not every nonprofit fits that criteria. Not every employee has been there for 15 years. And then there are a couple of other things that you need to tick off certain check boxes. But if it works well for your organization, then maybe 403B makes sense. Okay, another benefit for using a 403B for some organizations is that you can make it a non-ERISA plan. And essentially that means you don't follow certain rules and regulations related to retirement plans. And we're not talking about you got to do a bunch of illegal stuff, but the administrative burden is a lot easier. You don't have to file certain forms and returns. It makes it administratively easier on the organization, and time is always at a premium, so that's helpful. Again, not every organization, not every nonprofit is going to be able to do that, especially if you do make an employer contribution, like a matching contribution, for example, that would disqualify you, but that's one potential benefit. And beyond that, there are a couple of other differences that, you get really into the details, and 403B plans have, one or two just weird things that apply to certain subsets of groups. For example, a minister's housing allowance might be right if you have a religious organization, or post-severance pay for certain employees who terminate employment, but you still want to make contributions to their account. These aren't things that are typically appealing to most, again, small private nonprofits that are, just doing things in the community. But in some cases, they can be, nice for helping people save for retirement. So I hope that helps you get an idea of what options are available to your organization, whether it's 401k plan, simple, payroll deduction IRA, or even a 403b plan. You've got lots of different choices. You can pick on how expensive it's going to be in terms of administrative costs and in terms of contributions to employee accounts. You can sort of pick a plan that makes the most sense for you. If you have any questions on that, please let me know. I'd be happy to talk with you, and we can make sure you get the plan that you need.